Let me be upfront with you right now, because what I'm about to share took me years to figure out, and most people sitting in your exact position have absolutely no idea this is even possible. If you own rental property and you're collecting income from it, there is a very good chance you are sending the IRS money every single year that you are legally not required to send them. Not because you're doing anything wrong, because nobody sat you down and walked you through the rules the way I'm going to do right now. I want you to stay with me through this entire video, because the strategy I'm describing isn't one trick. It's a combination of tax code provisions that work together, and if you skip the middle part, the end won't make complete sense. By the time we're done here, you're going to understand exactly how a landlord collecting $50,000 a year in rental income can bring their federal tax bill down to zero, completely legally, using rules that have been sitting in the tax code the whole time. Let's start with the one thing most rental property owners get wrong before we even talk about deductions or depreciation or anything else. Most people think of their rental income the way they think of a paycheck. Money comes in, you report it, you pay taxes on it. That mental model is the reason so many landlords overpay. Rental income is not taxed like wage income. It sits in its own category called passive income, and that category comes with its own set of rules, its own set of deductions, and in many situations, its own set of ways to reduce that taxable number dramatically before the IRS ever gets involved. So when I say someone paid zero taxes on $50,000 of rental income, I don't mean they hid anything or found some obscure loophole that's about to get closed. I mean they used the ordinary, everyday tax treatment that Congress specifically wrote for real estate investors and landlords. The rules are in black and white. Most people just never learn them. Here's where the first major piece comes in. It's called depreciation, and it is the single most powerful tool available to rental property owners. If you are not using depreciation correctly right now, stop everything and pay attention to this part. When you own a rental property, the IRS allows you to deduct the gradual wear and tear on that building over time. Not the land, just the building structure itself. For residential rental property, the IRS lets you depreciate that value over 27.5 years. That sounds like accounting jargon, so let me make it real with numbers. Say you bought a rental property for $200,000. Let's say the land is worth $50,000 of that, so the building value is $150,000. You divide $150,000 by 27.5 years. That gives you a depreciation deduction of roughly $5,450 every single year. You take that deduction whether or not you spent a single penny on repairs. The property could have been completely maintenance-free, and you still get that deduction. It's built into the law. Now here's why that matters for our $50,000 example. That $5,400 comes right off the top of your rental income before you calculate what you owe. You didn't spend it, you didn't lose it, you just claimed the deduction the law gives you, and suddenly your taxable rental income isn't $50,000 anymore. If you haven't subscribed to this channel yet, this is a good moment to do that. We cover tax strategies for property owners and retirees every week, and a lot of what we discuss involves exactly this kind of information that your accountant may not have taken time to explain in plain language. Now let's add the second layer, because depreciation alone won't get most people to zero. It'll help significantly, but we need to talk about operating expenses. Every dollar you legitimately spend running your rental property is a tax deduction. I want to go through these one by one because people constantly miss items on this list, and each one chips away at that taxable income number. Mortgage interest is deductible. If you have a loan on your rental property, the interest portion of every payment you make comes off your taxable rental income. On a standard 30-year mortgage, especially in the early years of the loan, that interest portion can be substantial. On a $150,000 loan at 6% interest, you might be paying $8,000 or $9,000 in interest in a given year. That's $8,000 or $9,000 that does not get taxed. Property taxes are deductible. Whatever you pay to your county or municipality for property taxes on the rental unit, that's a full deduction against your rental income. Insurance premiums are deductible. Your landlord insurance, your liability coverage, any policy you carry specifically for that property, all of it comes off. Repairs and maintenance are deductible in the year you pay them. Replaced a water heater? Deductible. Fixed a leaking roof? Deductible. Repainted the interior between tenants? Deductible. Hired a plumber? Deductible. These are the expenses people sometimes forget to track because they feel like ordinary life expenses, but they are legitimate business costs of running a rental. Property management fees are deductible. If you use a property manager who takes 10% of your rent every month, that entire fee is deductible. Professional fees are deductible. What you pay your accountant to prepare your rental income taxes, what you pay an attorney to review a lease, those are deductible. Travel expenses related to managing the property are often deductible. Driving to the property to check on repairs, trips to the hardware store for supplies specifically for the rental, these can be tracked and deducted at the IRS standard mileage rate. Advertising costs are deductible. What you spent listing the property to find tenants, whether that's online listing fees or signage, comes right off. Now let's start putting real numbers together. Take that $50,000 in rental income, subtract $5,450 in depreciation, subtract $8,000 in mortgage interest, subtract $3,000 in property taxes, subtract $1,500 in insurance, subtract $2,500 in repairs, subtract $1,000 in property management fees. You have already reduced that $50,000 in gross income down to around $28,600 in taxable income. We've cut the taxable amount nearly in half, and we haven't even gotten to the most powerful strategies yet. This is where a lot of people think the story ends. They do the math on their standard deductions, they see a number that still has some tax attached to it, and they write the check. But there are two more strategies that, depending on your situation, can bring that number all the way to zero. Let's talk about both of them. The first one is cost segregation. This is a strategy that bigger real estate investors have known about for a long time, but it's now accessible to smaller landlords too, and it can create a massive deduction in a single year. Here's the concept. When we talked about depreciation, I explained that the building structure depreciates over 27.5 years. But not every component of a building is the same. Carpeting, appliances, landscaping, certain electrical components, parking lot surfaces, and other specific items have shorter useful lives under the tax code. Some of those components can be depreciated over 5 years or 15 years instead of 27.5. Cost segregation is the process of having an engineer study your property and identify which components qualify for faster depreciation. When you reclassify those components correctly, you can pull forward years of depreciation deductions into the current year or the first few years of ownership. Instead of getting $5,000 a year in depreciation for the next 27 years, you might legitimately claim $15,000 or $20,000 in the first year because a significant portion of your property qualifies for accelerated treatment. When you combine a large cost segregation deduction with your normal operating expense deductions, you can find yourself in a situation where your deductions actually exceed your rental income for the year. That's a paper loss on a property that is generating real positive cash flow for you. And in many situations, that paper loss can offset other income or eliminate your rental income tax entirely. Before we keep going, if you found this breakdown useful, the best thing you can do right now is hit the like button. It takes 1 second, and it tells the algorithm to show this video to more landlords and property owners who need to hear this information. If you know someone who owns rental property and might be overpaying in taxes, share this with them directly. The second advanced strategy connects directly to the 2026 rule change I mentioned in the title, and this one specifically matters for anyone who has significant rental income, but also has flexibility in how they're involved with their properties. Under the tax code, rental income is generally treated as passive income, and passive losses from rental activity can generally only offset other passive income. That's the default rule. But there's an important exception for people who qualify as real estate professionals under IRS rules, and there's a separate exception for active participation landlords, which has different and more accessible requirements. Let's talk about the active participation exception first, because it affects more people. If your adjusted gross income is under $100,000 and you actively participate in managing your rental property, which means making management decisions like approving tenants, setting rents, and deciding on repairs, you can deduct up to $25,000 in rental losses against your ordinary income. That exception starts phasing out between $100,000 and $150,000 of adjusted gross income. For retirees and seniors who are living primarily on Social Security and modest retirement distributions, that income level is often within range. If your combined income, including Social Security, is under $100,000, this exception could allow your rental property deductions to work against all of your other income, not just rental income, which dramatically changes the tax math. Now here's where 2026 specifically becomes important. The Tax Cuts and Jobs Act provisions from 2017 are scheduled to expire at the end of 2025, and several changes affect real estate owners directly. The 20% qualified business income deduction, often called the pass-through deduction, has been part of tax planning for rental income in certain circumstances. The standard deduction amounts are reverting. Bonus depreciation rules are changing. The exact treatment of several deductions that rental property owners have been using is in flux. Congress has been debating extensions and modifications, and if you are planning your tax strategy right now for your 2026 returns, you need to be working with a CPA who specializes in real estate, not just a general tax preparer, because the interaction between these expiring provisions and your rental income could go in very different directions depending on the choices you make in the next 12 months. What I can tell you is that the core strategies, ordinary depreciation, operating expense deductions, cost segregation where it applies, and the active participation exception remain intact regardless of how the TCJA provisions resolve. These are foundational elements of rental income taxation that have survived multiple rounds of tax reform because they reflect genuine economic principles about how rental property works. Let me now walk you through a complete scenario so you can see how all of these pieces fit together into a real situation. Imagine a 68-year-old retired teacher who owns a single-family home she's been renting out for 4 years. Her tenant pays her rent totaling $50,000 a year. She lives on a combination of Social Security and a small pension, and her total adjusted gross income, including the rental income, runs around $90,000. She actively manages the property, approves her tenants, and makes repair decisions herself. Here's what her tax picture looks like if she knows these rules. Her property was purchased for $220,000, with the building value assessed at $180,000. Her annual depreciation deduction is $6,545. Her mortgage interest for the year is $7,200. Property taxes are $2,800. Insurance is $1,400. She had a furnace replacement and some plumbing work totaling $3,200. She pays a 2% property management coordination fee of $1,000. Her accountant charges her $800 for the rental portion of her return. Add those deductions together and you get $26,945 in legitimate deductions. Her $50,000 of rental income is now taxable at $23,000 and change. But here's where it gets even better. Because her adjusted gross income is under $100,000 and she actively participates, she can use the passive loss rules to her advantage if she structures correctly. And her accountant, doing a cost segregation analysis in year 1, identified $14,000 of components that qualified for faster depreciation. In year 1, that accelerated depreciation alone wiped out a substantial portion of her taxable rental income. The point is not that everyone will hit exactly zero every year. The point is that the gap between what most rental property owners pay in taxes and what they are legally required to pay is enormous, and it exists entirely because of strategies that are sitting in plain sight in the tax code, waiting to be used. Here's what I want you to take away from this and actually do with it, because information without action doesn't help you. First, pull out last year's tax return right now, or as soon as this video ends, and look at Schedule E. That's the form where rental income and expenses get reported. Look at whether depreciation was claimed, and if so, whether it looks proportional to the property value you own. A surprising number of people have rental properties on their returns where depreciation was either never claimed or was calculated on the wrong basis. Second, if your Schedule E shows consistent positive income year after year, with very little in the way of deductions, that's a signal to have a conversation with a real estate tax specialist. Not just a tax preparer, but someone who works specifically with rental property owners and understands cost segregation, passive activity rules, and how to structure your participation to maximize the available deductions. Third, if you haven't already, start tracking every expense related to your rental property in a dedicated place. Separate bank account, separate credit card, dedicated folder for receipts, whatever system works for you. The deductions are only useful if you can document them. The IRS doesn't dispute deductions you can prove. They absolutely will question deductions you can't. Fourth, if you're within a year or two of either buying a rental property or selling one, get a consultation before you close that transaction. The tax consequences of rental property purchases and sales involve timing decisions, cost basis calculations, and depreciation recapture rules that can either save you significantly or cost you significantly depending on how the transaction is structured. The phone number for the IRS is 1-800-829-1040 if you have questions about rental income reporting. For questions about specific programs or forms, the IRS website at irs.gov has a landlord and rental income section under the publications area. Publication 527 covers residential rental property in full detail, and it is written more clearly than most people expect government documents to be. If you've been watching this channel for a while, you know we don't just talk about these topics theoretically. We try to give you the actual mechanisms and the actual numbers so you understand not just what to do, but why it works. If this is your first time here, subscribe before you go, because we cover this kind of ground every week for property owners, retirees, and anyone trying to make sure they're keeping as much of their own money as the law allows them to keep. The most important thing I can leave you with is this. The tax code is not written to help the IRS collect more money from you than they're entitled to. It's written to collect exactly what Congress decided you should owe, and Congress specifically decided that rental property owners deserve significant deductions because rental housing serves an important function in the economy. Claiming those deductions isn't aggressive tax planning. It's following the law the way it was intended to be followed. You work to acquire that property. You take on the responsibility of maintaining it, finding tenants, dealing with repairs, and managing the financial risk of ownership. The deductions available to you are recognition of that work and that risk. Use them.